So SoFi just announced a 1.5 billion stock offering. And if your first reaction was, wait, dilution? Yeah, Wall Street reacted the same way. But here's the thing, this move is way deeper than just selling the shares. So today, we are breaking down exactly what SoFi just did, why they did it, and how this could impact your portfolio in the next 12 months. So what actually happened? Let's start with the facts so we are all on the same page. SoFi announced a public offering of about 54.5 million shares priced at about $27.50, totaling roughly about $1.5 billion. They also added a 15% greenshoe option, which simply means that if they are saying to the underwriters, if the demand is strong, go ahead and buy another 8 million shares. So the raise or this raise could be closer to 1.7 billion. And importantly, this is a primary offering, meaning SoFi itself is issuing the shares. No insiders are selling, no hidden motives, nothing. This is company simply raising the cash. So why did the stock dropped? Of course, as we can see, if you looked at the chart after hours or even in pre-market right now, we saw the drop. That's textbook. When a company issues new shares, everyone freaks out because existing shareholders get diluted. It's like cutting pizza into more slices or multiple slices. Everyone gets slightly less per slice. But here's what's interesting. I see this more like profit taking now of what the reaction was right away, as the retail investors are hardly that quick to sell. I mean, how many of you really sold the share because of this news? But still, we saw the price drop because a lot of institutions came in and they were taking the profits. These are all big institutions profit taking mostly just to take advantage of what's happening right now. Now, the question is, why? Why SoFi did this? SoFi didn't raise $1.5 billion for fun. They raised it for 3 reasons, and these are all directly from the filings. Number 1, strengthening their capital position. SoFi is scaling fast. More loans, more deposits, more customers. A big balance sheet gives them room to do more of that responsibly. Number 2, increase financial flexibility. This cash gives SoFi the ability to pounce on opportunities, acquisitions, partnership. That is basically expansion without borrowing at higher rates. I would do it. Number 3, fund incremental growth. SoFi has been rolling out new product at an insane pace. This raise gives them the ammunition to keep moving aggressively in 2025, 2026. Think of this as adding money to your brokerage account because you want to be ready when the market drops. Now, let's look at all 3 scenarios. First, I'm going to start with the bullish case. And by the way, if you haven't already, go ahead and smash that like button. It helps pushing the video to more investors like yourself, and subscribe if you haven't already. Okay, so now let's talk about upside. Raising 1.5 billion at strong share price is actually a flex. Companies usually raise money when the market likes them, and right now, SoFi is up big on the year. This could help with the lending growth, or improve margins, or reduce funding risk, or help with acquisitions. This is what mature financial institutions do. They build a fortress balance sheet. And SoFi has gone from startup to bank to expanding financial platform, and this helps with that. Now, the bearish case. But there is always another side, right? Here's the bear case in a nutshell. Dilution is real. Your share of the company shrinks. We already see stock going down 7 to 8% pre-market, and this could get worse. Earnings per share could also take a temporary hit. Number 2, SoFi now needs to prove they can deploy this 1.5 billion efficiently. They don't, investors will punish them. And then number 3 raises questions about timing. Why now? Do they see macro risk ahead? Do they need extra capital cushion? All fair questions to ask. But what does that mean for us investors? Because as I'm concerned, I want to know how the company is doing, why they are raising cash, and what does it mean for me going forward. So here's how I look at it. Short term, stock will be volatile unless we get some good news like the S&P inclusion everyone is talking about. But that'll be temporary boost, as that could be sell the news kind of event, because the real effect of S&P will show up in next quarter, in my opinion. And if this S&P happens right now, I doubt it, but we'll see. So maybe a temporary pullback as dilution gets priced in. Long term, in my opinion, this is a power move. And if SoFi executes, especially big raises like this often mark inflection point in companies that are scaling. Amazon, Tesla, Apple all raised big capital during growth phases. Today, we celebrate those raises, but back then, everyone hated them. Here's my final take. SoFi is making a big boy move here. raising capital at strong prices, strengthening their balance sheet, and giving themselves room to keep building. Dilution isn't fun, but growth rarely is, and that's why we call it growing pains. So if you believe in SoFi's long-term ecosystem, this move fits that story perfectly. And I believe that the reason why SoFi is doing it, to kind of prove that they have the capital, they have the ammunition to basically execute what comes next. Could be a big acquisition happening, could be a new product rollout happening. I mean, they are firing on all cylinders. So if you want me to break down the exact technical levels to watch on SoFi after this offering, drop a comment below and smash that like button. And if you haven't subscribed, then go ahead and subscribe to watch more videos like this. And I'll see you in the next one.